Right then, welcome. Good morning, everybody. Thanks for logging on and joining us today. So we've got what I think is going to be really interesting and very topical webinar for you today, the latest in our series of Pulse webinars. So, I think we will all take calls, be it platforms, whether we're investment managers, whether we're advisors, we'll all take calls from clients who are nervous at times like these, when perhaps markets are very volatile, when there's very prominent world events. Obviously we've had COVID not so long ago. We now have a war. Lots of talk, obviously, of inflation being at levels not seen for many a year. So, that topic of staying invested during volatile times is obviously one that's very much at the fore at the moment. And I think there's a common goal here. It's in everybody's best interest, be it the client, be it the platform, be it the asset manager, be it the advisor, to make sure that the clients are confident and remaining invested, and see the benefits of being invested at times such as these. So, in fact, sort of anecdotally, I was speaking with my dad over the weekend, who stumbled across an old pension pot he didn't realise he had, and he commented that over the last couple of weeks it's gone up a lot, and he said, "Oh, if I notice it starts going back down again, I'll just start withdrawing the money out." And so I thought, well, okay, perhaps I need to make sure he's logged on this morning. So. Clearly, I'm not doing a very good job of educating my own family. So what I'll do now is pass over to the experts, and I'm very pleased to be joined by Ben from Brooks Macdonald. So I'll pass over to you, Ben, and you can take us through this one.
Thank you very much, Darren. So just by way of brief introduction, I joined Brooks Macdonald in 2017. 5 years does seem like a lifetime, given the global events that we've all been going through over the last few years. And worryingly, when I look at my bio, starting in 1998 in financial services, feels a very, very long time ago. So I co-head our multi-asset class team at Brooks Macdonald International, and also sit on our group's asset allocation committee. So hopefully I can give you guys some insights into how we see markets developing in the coming months during questioning. But as Darren mentioned, if we could move on to the next slide, please. The crux of what we want to talk to you about today is how navigating these volatile times and helping clients through what can be a very emotional and difficult time when they see their values on their portfolios draw down significantly. As Darren alluded to, he's having discussions with his father about taking money out at a point in time when markets are low. So we just thought that it'd be useful to be able to provide you with some material that might help support those discussions, and reminding clients that if we focus on their time horizon, in the main, our clients tend to have a long-term time horizon when they're undertaking an investment plan. It's about describing that long-term view and explaining the damage that missing out on some of the best days in markets can have on someone's wealth. And interestingly, emphasizing that a lot of the best days we see in markets are quite closely linked to the worst days as well. So we've got a slide on that. We'll also touch upon cash and just mention that the natural reaction for a lot of investors is to cash out, sit in cash, and how that might not be the best strategy to maintain wealth, particularly as Darren mentioned, given the heightened levels of inflation that we've got. So this slide just shows the MSCI world performance through time back to 1971, and the various annotations show very major market, geopolitical and economic events that have happened throughout time. It also serves for me as a reminder of how long I've been doing this. So I can remember working in the office about halfway along this chart. So for me, it feels like a reminder of how grey-haired I am. So back then, you can see the peak of 2000. I just started working on a dealing desk in November of '99, so saw the final flurry of the tech bubble. A lot of spending on the Millennium Bug, and IPOs coming to market, rising threefold was a regular occurrence. And then obviously post that, we had this very damaging steep decline in markets. And a lot of the same discussions we were having with clients then, we had in 2008 when the financial crisis occurred. But again, slightly different in that rather than the loss of capital, people were worried about actually getting their money back out from banks. So it was a bit more of an existential crisis back in 2008 and 9. Then clearly we had COVID in 2020. But the message from this chart is that throughout all these really big events in markets over time, that by investing in good quality, large companies who have an ability to reinvest in themselves, innovate and generate good profits to shareholders, that the returns that one can achieve are very, very strong. So it's a question of trying to ride out these periods of volatility. And we all have clients that are sanguine when markets decline because they have that long-term view. But we also have those clients that are a bit more nervous and need a bit more hand-holding. So in terms of our next slide, please, Steve. So clearly we can see just buying and holding equity markets over a long period of time is a relatively successful strategy. You can see here the last 20 years, the blue line denotes the portfolio performance if no changes were made, dividends reinvested. But the burgundy line below shows what happens if you miss just the 10 best days in markets. So being out the market for a very, very short period of time, or on those 10 particular good days, can have a meaningful impact on your overall wealth. And the outcomes you achieve over time can be significantly different. And again, the yellow and blue lines below show that the damage that can be caused by missing the best 30 and the best 50 days can be even more severe. So our message to clients is be patient. There will be volatility in investing. It's about finding that correct level of risk that you're able to tolerate and that you're willing to take. And so the message from us is always keep an eye on the time horizon, make sure that you're not taking too much risk, but ultimately, in order to achieve your financial goals, it's necessary to take some investment risk. Next slide, please, Steve. So 20 years clearly is, in some people's mind, a long period of time. But if we take a short-term view, what happened during COVID? Clearly, it was a slightly unusual time in markets because of the speed of the decline. And we hit bear market territory in just 25 trading sessions in the US, which was a phenomenally quick amount of time. By way of comparison, it took nearly 280 days in the financial crisis to reach the bear market. So clearly, there was a fast-moving global event. However, missing the best days of the post-COVID recovery, which closely followed the declines, would have had a severe impact on one's wealth and the outcome achieved. I'm sure, like you guys, we had discussions with clients during the peaks of the pandemic where people were generally concerned that the world will never be the same again. And we had clients that we had to try and talk around, but unfortunately, there was a few that cashed out right near the bottom. So we've experienced a period in time where people were making emotional decisions because they couldn't sleep at night, and there's only so much you can do in terms of trying to guide those people. However, the data would support our long-term view that remaining invested is the key. The next slide, please, Steve. It shows the same data as the 20-year chart I alluded to earlier, but just annualizing the returns. So again, a strong picture that denotes that staying fully invested throughout the period is really a key to success. The next slide, please, Steve. So as I mentioned earlier, this chart demonstrates how close in time the best and worst days can be in markets. So the horizontal axis shows the dates in time, and the purple dots below show the largest declines in those periods. The turquoise lines above show you that in terms of time, the best days tend to quickly follow the worst days. And to some extent, that's a natural reaction because people see opportunity. They see value being created by being able to buy an asset for a lower price. But it also reflects the fact that we know that central banks are active in markets. The US have their financial stability fund, and they'll buy S&P 500 ETFs when they feel that the market declines are becoming too excessive. So some of that price action where we see big swings in the S&P 500 intraday tend to indicate that the Federal Reserve are getting involved in deploying some capital. We know that the Bank of Japan is one of the biggest holders of Japanese equities because they continue to try and support equity markets there. So it's natural that we get these big, strong bounce backs. But it also demonstrates that if you try and cash out during bad times, quite often you're highly likely to miss that upswing. And the previous charts show that by missing those upswings, the outcome that you achieve could be significantly different. But clearly, we've all had those discussions where clients become very, very concerned with market volatility and the value of their portfolio. So we can understand that in times of crisis, people wish to try and de-risk in their own minds. So the next slide takes us to talking about de-risking and what that might look like. So clearly we can move to gilts or bonds if you're worried about equity market volatility. But the predominant tool that people use is cash. So this chart, the lighter blue lines show the value, the notional value of $10,000 placed in cash on a 3-month deposit for 20 years. So whilst clearly with the benefit of interest rates over that time, a nominal return could be achieved, when we factor in inflation, the outlook and the result is very, very different. And the same for the dark blue lines, which denote 3-month cash invested in sterling. So holding cash for protracted periods of time in relatively high inflation environments can be a meaningful damaging effect to clients' overall wealth. So we can see here that both in sterling and in dollars, the real purchasing power of that 10 million invested in cash would be just over 8.5 million today. So a meaningful destruction of wealth. And if we overlay the equity chart, the 20-year equity chart that we had earlier on in the pack, you clearly see that the equity markets can accelerate well above inflation. And it's natural to some extent that occurs because companies that have purchasing power and strong brands can usually pass on price increases to their clients to some extent and continue to innovate and invest in order to grow. So our message on this chart is making sure that clients don't just sit and hold cash ad infinitum and make sure that they deploy it in a sensible investment plan. So the next slide, Steve, please. So what can we do during volatile times to protect wealth? Clearly, at this point in the cycle, it's been very difficult. If we were to show, we only go up to 2021 because we're using annual periods here. But if we were to show 2022 on this chart as a year to date, clearly the vast majority of these headline asset classes will be in negative territory. So we are at an inflection point. This is not unprecedented in markets. We saw this in the late 80s and back in the 70s where bonds and equities fell in concert. But generally speaking, by constructing portfolios of multiple asset classes and by actively asset allocating, we believe that value can be added over time. And clearly the predominance of the stronger parts of the market you can see here, US equities throughout history have tended to do very, very well, aside from certain periods. And again, that reflects back that equity investing, buying good quality companies can really drive returns over the long and medium term. So our focus remains on constructing our portfolios using best-in-class managers that have access to these various regions, but also taking a top-down view and making sure that we're not exposing client portfolios to the worst of those parts of the market, and making sure that we're appropriately diversified. So in terms of performance, Steve, I'm going to move on. This slide just denotes this longer-term journey that client portfolios have been on. We've just selected our balanced fund. It's the predominance of our assets are held in our balanced risk portfolios. And a couple of periods here that spring to mind. The back end of 2018 was clearly very difficult. Not dissimilar to now. The Federal Reserve were talking about quantitative tightening. That spooked the markets. We had some geopolitical concerns with Donald Trump's trade war with China. So there's a lot of rhyming to what's going on right now, where we've got the Fed undertaking quantitative tightening along with the Bank of England, and geopolitical situation in Russia, Ukraine, which is causing fairly significant market dislocations. But throughout a sensible period of time, we can see that these volatile periods get ironed out by being able to position portfolios in various asset classes and taking different exposures, staying diversified, and seeking opportunity when those opportunities present themselves. And that's the key thing that we're doing right now, is making sure that we're focusing in on those areas where value is starting to be created and attractive opportunities that are presenting themselves. So I think that takes me to the end of my formal presentation. So Darren, have we had any? I'll hand back to you and see if we've had any questions.
Yeah, great stuff. Thank you for that, Ben. That was really good, really informative. I think there'll certainly be some for some useful intel there, and I think that that's very much the thoughts with these Pulse webinars is that it gives our users the opportunity to listen in and hopefully take away some useful information that that can be shared with clients when speaking with them. We have a couple of questions come through. Some I can answer myself, some I wouldn't dream of answering myself, so I'll pass back over to you. First one is just, will a copy of the presentation and with the charts be available anywhere? Yes, both will be made available online afterwards. And I've also had one regarding what portfolios Brooks Macdonald have available via Novia Global. And I believe that is sterling denominated and US dollar denominated, and that's across 3 different risk profiles as well. So questions for you then, Ben, were what can be done to protect wealth during volatile times?
So maybe if we can go back a couple of slides to the block chart that we've got there. So I mentioned that asset classes are falling in concert this year. That's not necessarily the full picture, because clearly with the situation in Russia and Ukraine, we've seen a very, very large spike in commodity prices, particularly oil and gas. And so naturally, any companies that are investing in the oil and gas sector have done very, very well. And that's led to quite a large outperformance for value style companies versus growth companies. So we've seen technology shares in the main very badly beaten up as investors are focused on the perceived safety of higher income type and value type investments. Interestingly, from this morning, CNBC were noting that in the last 30 days, $1 trillion has been wiped off large cap tech valuations. So it's clearly a time in the markets where these big swings are happening. I'm sure you've all seen the news on Netflix falling nearly 50% this year, having lost just 1% of its subscribers. So that kind of describes and explains the market psychology at the moment. Anything growth related that disappoints is getting absolutely punished, whereas anything with a perceived level of safety or pricing power is being well supported. So in these sorts of times, what we're doing at Brooks is making sure that we've got balance in portfolios. We want to have a decent amount of value exposure in certain parts of our portfolio, particularly in the UK, where that style of investing has been working well. But in the US, we are actually looking at those opportunities that are coming from the growth part of the market, particularly as valuations there have declined to such a great extent. We're now seeing good opportunities emerge. Property's done very, very well this year, and anything related to energy infrastructure has also done very, very well. Clearly, Europe's been on a transition, and arguably the globe has been on a transition in terms of its energy usage and trying to reduce the amount of fossil fuels in use. And the conflict in Russia and Ukraine has just emphasized the need for energy independence, particularly in Western Europe. So we think that a lot of investment in renewable energy has been brought forward and be refocused, particularly in the likes of Germany and France. So there's always things that we can do in portfolios to try and achieve those attractive medium to long-term returns.
Good stuff. Thanks, Ben. Right, we are actually getting quite a lot of questions come through here, so I'll throw a couple more at you if that's okay. And then over and above that, perhaps we can look at a way of we can put any questions I don't get a chance to ask you, and perhaps put a note together and circulate to attendees afterwards. So one we've had is technology stock has been very badly hit this year. How do you view the sector?
Yeah, so clearly there's been some big swings. I alluded to the $1 trillion being wiped off valuations. I think the key for us is focusing on a technology space that's larger in nature. Clearly, some of the smaller capitalization names have been very badly hit, but also by utilizing an active manager in that space, we're able to, he's able to actively maneuver the portfolio around to areas that are showing the best characteristics. So again, for us, it's about viewing those longer term opportunities in the market. And clearly, technology is something that we use on a day-to-day basis. We're hosting calls on Zoom. I'm sure we're all working in a hybrid manner, which is completely alien to 20 years ago when we all had to work from the office. So we believe that these long-term technology trends will continue, particularly in relation to new technologies like 5G that are coming out, and it could be a game changer in terms of how we live our lives with that high-speed connectivity and connected living, automation, and artificial intelligence being brought more into the consumer space. So clearly, there are, in our view, there are very good opportunities long-term, but clearly the market declines we've seen thus far of this year have been very damaging. But in that has created opportunities.
Thank you. Right, another one we've had is with multiple asset classes all falling in concert at the moment, how are you investing client portfolios?
That's a good one. So again, staying diversified, making sure we're not taking any oversized risk bets in any one area, and making sure that we've got regional allocations that are appropriate. So clearly the invasion of Ukraine has affected Europe far more greatly in terms of geopolitical positioning than the US, for example. So I think with the US being a very, very flexible economy and far more insular in nature, the likelihood is that the US investment markets will remain relatively protected from what's going on in the ground in Europe. To some extent the UK, but still the importance that we're placing on diversification is really what we're trying to achieve here. And at the moment, a barbell strategy for us of making sure we've got cyclical exposure, largely from Asian markets. We've got some value exposure from the UK and also internationally, and a bit of growth from US investments. We want to make sure that balance is key in everything we're doing, and diversification. I alluded to earlier that some of the infrastructure plays have done very, very well. So we're making sure that we've got exposure to those strong long-term themes that are emerging.
That's great, thank you, Ben. Right, so one more, I think we'll do it. That's okay. This one from Tom. So, thoughts on gold? Question mark.
Gold is the gold market is an interesting one. Clearly, one of the oldest safe haven assets in the investing world. It's been used as currency for however many thousand years, but really has found its place in markets and portfolio constructions somewhat diminished over the last few years, predominantly by crypto. Crypto's has similar characteristics in its perceived safety, although you might want to debate that in relation to the ease in which it can be hacked. But nonetheless, people seek safe harbors in these volatile times, and gold over many years has been the go-to asset class. The problem with gold is that it doesn't produce an income. So when we look at the 10-year treasury in the US, for example, yielding 3% now, its relative attractiveness in terms of safe haven is diminished by the fact that you can get a decent return now, arguably, on 10-year treasuries. There's also a supply and demand issue with gold in that Russia is probably the fourth largest, I think, holder of gold as a central bank. So clearly, if sanctions were to be used more broadly to try and persuade Russia to change course in the Ukraine, it's possible that the gold market is used as a tool to do that. So for us, we're not looking to gold at this point in time to try and preserve clients' wealth or as a safe harbor. I think at this point in time, we're probably looking more towards sovereign debt to do that job for us.
Brilliant, thank you. What, time for one more maybe then? Sorry, keeping you on the spot here, Ben, is this okay? Great, so last one, the interesting question I think just come through. So because companies are pulling out of Russia and the fact that certain European banks are quite exposed to the Russian economy in terms of debt, deposit and investments, do you foresee a knock-on effect?
Yes, so clearly the European banking sector has been difficult for many years, as we all know. Never really recovered balance sheets from the financial crisis and has swung from one difficult situation to the next. Clearly, negative rates haven't helped European banks, and so I think the Russian situation and the freezing of assets arguably is again yet another difficult situation for European banks. It's one of the reasons that Europe isn't a large part of our investment universe for clients who are based in dollars or sterling. Clearly, for euro-based investors, it's a different conundrum because there's an element of currency risk that you want to mitigate there. But generally speaking, for a global investor, we continue to avoid Europe, particularly domestic Europe, which is likely to be harder hit by the crisis in Ukraine and any issues within the banking sector that might follow.
Great. Okay, I think we'll leave it there, but thanks very much indeed for that, Ben, and for the presentation. And as I said before, some really useful stuff in there. I think, something that particularly caught my eye was that chart showing the investment returns, remaining fully invested versus missing, X number of the best days. So definitely some useful stuff. We're getting lots of people asking about whether the slides and the presentation are going to be available online, and the answer is yes, and we'll share those with all the attendees as well. So just to reiterate that once again. So yep, thanks very much everybody that has joined us today. The next Pulse webinar that we do just keep an eye on your emails, and that's going to be on the subject of blockchain. So keep an eye out for that one. Yeah, but thank you once again for your time, and we will see you all again soon.
Thank you.
Bye-bye. Thanks, Ben.